The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. I'm Hongbin Jeong. Now, President Trump's return to the White House has set the stage for significant shifts in the global geopolitical and economic landscape and created uncertainty and market volatility. Of course, trying to predict what Trump is going to do next is always a challenge. Thus, with his unpredictability, investors are faced with uncertainty along with market and portfolio volatility. So, can a case be made for investing in bonds to bode well during Trump 2.0? Why should investors always have a diversified basket of bonds in their investment portfolios? Well, to find out more, joining me now is Vasu Menon, who is the Managing Director of Investment Strategy at OCBC. Vasu, welcome to the show.
Thank you very much for having me on the show.
Thank you so much for joining us. Vasu, of course, trying to predict what Trump is going to do next is always risky business. That was already well witnessed during his first term in office. Given Trump's unpredictability, this also means more volatility in markets. So, Vasu, does this mean investors should not invest in markets and stay in cash instead?
I don't think so. I think investors should stay invested in the market. Staying in cash is a risky strategy. No doubt, as you mentioned earlier in the show, that Trump has injected quite a bit of unpredictability and volatility into the financial markets. But at the same time, I think economic growth is still relatively healthy. There's a lot of cash sitting on the sidelines. And historically, looking forward with this sort of backdrop, positive earnings growth, positive economic growth, lots of cash sitting on the sidelines, a very healthy level of skepticism is what it reflects. In the markets will probably hit higher over the next 2-3 years. What's going to happen in the next 1-2 months is hard to predict. But I think for medium-term investors, there's still a case for investing in the markets on the basis that you see continued economic growth, continued earnings growth, and that typically are the key fundamental drivers of the market that will produce returns over the medium term.
I see. Well, going back to Trump 1.0 then, Vasu, how did investors ride out the volatility back then?
Well, we saw a lot of volatility in Trump 1.0 as well, just like we were seeing a lot of volatility now with Trump 2.0. Just to give you an idea, in 2017 when Trump took office, one of the first things he did was cut taxes, and as a consequence, you saw equity markets globally and in the U.S. rally very sharply. And then in 2018, he began the trade war. And along with that, the Federal Reserve tightened monetary policy quite significantly, pushed up interest rates 4 times that year, and instituted quantitative tightening. And that caused global markets to pull back. Global equities fell by 11%, U.S. equities fell by 6%. But in the next 2 years, in 2019, 2020, the markets faced a very strong rebound. Global equities were up 24% in 2019 and 14% in 2020. So if you pick the 4-year tenure that Trump was in office in Trump 1.0, you saw quite a bit of twists and turns in market volatility. But over that 4-year period, equity markets did fairly well.
I see. Well, then can investors stick to the same investment strategies and portfolio allocations that worked in Trump 1.0 for Trump 2.0?
Well, I think investors should keep a very diversified portfolio. I think we've said this many times. It sounds maybe something that a lot of investors have heard of before, but I think at the current juncture in the markets, and there are lots of twists and turns, many moving parts, I think it's important for investors to keep a diversified portfolio. I think the strategy that adopted in Trump 1.0 is still applicable in 2.0 because we are of the view that, over the next 2 years, 3 years, 4 years, the economy in the U.S. will still hold up fairly well. Global economies will still hold up fairly well. Earnings will still come through. And we'll see a lot of volatility in the markets. We'll see periods of pullbacks in the markets, but we think that, there's scope for the market to hit higher over the next 3 to 4 years. So what we saw in Trump 1.0, where the markets actually did fairly well over a 4-year period, could play out again this time around.
I see. Well, Vasu, while the case for equities supported by Trump's deregulation, tax cuts, and greater fiscal spending is a well-known one, the case for bonds is often less articulated. So what's the case for bonds then? What are the reasons investors should invest in bonds, especially in the current market?
Well, you're right. I've spoken quite a bit about equities and Trump 1.0, Trump 2.0, not saying enough about bonds, but I did highlight the importance of having a diversified portfolio. And I think, there are a few benefits of bonds. Bonds are portfolio stabilizers. They are less volatile than equities, and, they kind of anchor the portfolio as a consequence. The other advantage of bonds is they offer income, they offer yield. So for investors who are worried about capital volatility, they actually enjoy income and yield, especially for older investors who need that cash flow and income, I think, bonds can be quite beneficial. And of course, the third benefit of bond, I think, is essentially that it offers a cushion in the event of unexpected economic slowdowns in the U.S. economy, elsewhere. Bonds tend to do well if there is a slowdown in the economy, tendency for the Fed to cut rates. Bonds tend to do well in that sort of environment. So I think you don't want to throw all your money into equity markets. You want to make sure that you don't throw all your eggs into one single basket. You want to make sure that you have a balance, adopt a balanced investment strategy. And from that perspective, it makes sense for investors to have some bonds in addition to equities in their portfolio.
I see. Well, Vasu, we're already a couple months into this new administration. How are bonds faring so far then?
Well, actually, bond markets have done relatively well so far because the 10-year bond yields in the U.S. have actually come off from 4.8% at the peak in January this year to now about 4.25%. So the decline in bond yields is because, bond prices have appreciated. It's a reflection of bond prices appreciating. So, of course, the returns on bonds are not going to be as spectacular as equities. So investors have to be realistic. With equity markets, strong double-digit returns are possible. With bond markets, single-digit low teens possible, but I think bond markets in the first few months of this year actually held up fairly well because of the very volatile equity markets. And what has happened is investors have kind of shied away from equities and put money into bonds and things that they feel offer a bit more protection.
I see. Well, then if investors are invested in bonds for, the long term during this administration, what kind of returns can investors expect?
Well, it's very hard to put a number. It depends on the kind of bond you invest in. It depends on the companies you invest in, whether it's sovereign, whether it's corporate, whether it's U.S., Europe. But, I think, as I said, bonds can offer potentially even high single-digit returns, low teens, over a long period. You can't just look at the bonds in terms of its coupon. Bonds offer coupon. That offers you income and yield. But beyond that, there's also scope for the prices of bonds to appreciate, especially if, interest rates are cut, if the economy is going into some kind of difficulties, bonds could actually do well. So bonds offer both the potential for capital appreciation as well as income. So if you add capital appreciation to income, it's possible that you could get, single-digit returns, potentially even high single-digit returns or low teens.
I see. Well, speaking of the different types of bonds here, what are the different types of bonds that investors can invest in? Is there a particular bond that, bodes well compared to the others in this current market?
Well, there are different kinds of bonds, quite varied. I mean, you got what we call fixed-rate bonds where the bond issuer offers you a fixed coupon. It doesn't vary. Some investors are, quite happy investing in bonds like that. You got floating rate bonds where the coupon is not fixed. It is tied to some kind of a benchmark that is, market-oriented, market-driven, tends to go up and down, and therefore, the coupon you get on the bond tends to vary. You've also got bonds called perpetual bonds where, there's no maturity date. But of course, the company can redeem the bond if it chooses to. Some companies will have what they call a call date where they may choose to redeem the bond, usually over a 5-year period or 10-year period. And if they don't redeem the bond, typically they tend to increase the coupon that they give you, that you get from perpetual bonds. You've also got what we call convertible bonds, where you can convert the bonds that you hold into equities. And perhaps last but not least, government bonds, sovereign bonds, bonds that are fairly safe. So, it's quite varied. I think for investors with a stronger risk appetite, go for corporate bonds, what we call high-yield bonds that may not have really solid credit rating but can offer you pretty good yield. For investors who are looking for greater safety, maybe look for what we call investment-grade bonds, which are very highly rated, or even government bonds. The yields may not be as high, but at least, this bond's fairly safe compared to other types of bonds.
I see. Well, then, how much should investors allocate to bonds in their portfolio? And it's been a while since I asked my guests this question. Can the 60-40 rule work in the current market condition?
I think it can, I think there is no fixed answer to that question, in all honesty.
Right.
The amount that an investor puts in bonds depends to some extent on, his risk appetite, which stage of the life cycle is in, his time horizon, various factors. So, for example, if you are a young investor, in your 20s, maybe early 30s, I mean, you don't want to put 40% of your money into bonds. You may only want to put 10%, 20% into bonds and, the rest of it into something like equities because you've got a long horizon. That's the asset of a young person. They've got a very long time horizon. They can stomach the kind of volatility, enjoy better returns than what bonds can offer. But if you're an older person approaching retirement, perhaps someone like me, then what you have to do is, put a bit more into bonds so that you enjoy yield, greater stability. So, 60-40 is a general rule. It's something that, a lot of investors talk about. But I think investors should not invest 60-40 as simple as that. I think they should really talk to a financial advisor and lay down their expectations, their financial circumstances, their risk tolerance, and other factors need to be taken into account before you decide what combination. But it should be a combination. It can be 80-20, 70-30, 60-40, 50-50, depending on your time horizon, your risk appetite, and what you're looking for.
I see. Well, before we let you go here, Vasu, are there any risks investors should be aware of when investing in bonds? I mean, what are the challenges fixed income securities may face, especially in the short term?
Yep, I think that's a very good question, because the way I've positioned my angle has been that, bonds are a portfolio stabilizer, safer than equities, and, therefore provide some sort of stability to your portfolio. They can. But at the same time, bear in mind that, for example, if you invest in corporate bonds that may offer you higher yield, slightly more risky companies which don't have as strong balance sheets, and these companies can offer you high yield. Possible that some of these companies may eventually go bankrupt, go bust. That wipes out your investments. So you've got to be careful. When you invest in bonds, it's important to look at the credit matrix of the underlying entity, the company or the government or, whoever is issuing the bond. I think that's important, the credit standing of the bond. I think the second risk that comes with bonds is not very often talked about, is what we call duration risk. And that means that, long-dated bonds tend to be more susceptible to price swings compared to short-dated bonds. So if we are of the view that, interest rates are going to increase quite significantly, for example, the 10-year bond yields in the US are going to go up, increase quite significantly, then you want to keep your duration short, or you want to buy shorter dated bonds because they tend to be less volatile compared to bonds that have very long tenors. So in a market like that, what we are telling investors is try and stick to the shorter end of the yield curve. In other words, invest in bonds perhaps between 3 and 7 years. Because anything beyond that means that, the bond is more susceptible to what we call inflation risk, interest rate risk, and price swings.
I see. Well, thank you so much, Vasu, for your time and your insights today.
Thank you very much for having me on the show.
Thank you. That was Vasu Menon, who is the Managing Director of Investment Strategy at OCBC. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.